Dr. Michael Burry just revealed his stock portfolio for the first time in 2 years. Now, if you're not familiar, Michael Burry was the one who predicted the financial crisis. Not only did he predict that a recession was coming, but he understood and anticipated exactly why that recession was going to occur. Because of this, his firm Scion Asset Management was able to make millions for investors betting against the subprime mortgage market. His contrarian investment bet was popularized in the movie based on Michael Lewis's book, The Big Short, which you may have heard of. However, since the financial crisis, we haven't heard too much from Michael Burry. That is, until now, because Michael Burry has just released his 13F filing for December of 2018. In this filing, for the first time in over 2 years, we have an inside look in the investments of the man who made millions during the last financial crisis. In this video, we'll review his portfolio and go over each of the 16 stock positions that he has in his fund. Before we get into it, if you're new to the channel, take a second to subscribe to get access to more investment content like this in the future. Now, getting back to Dr. Burry's portfolio. This is an interesting update because this is, like I've said before, the first time in over 2 years that we've had a look inside his portfolio. Prior to December 2008, the last 13F filings that were filed by Scion Asset Management were from the fourth quarter of 2015 to the third quarter of 2016. Now, firms are required to submit a 13F filing if they have assets over $100 million. Now, we know from that third quarter 2016 filing that Michael Burry was only managing around $35 million of assets at that time. This was below the $100 million threshold for that required 13F filing, but he decided to file anyway. However, from that point going forward, Michael Burry decided that he would no longer voluntarily file the 13F filing since he wasn't obligated to, as his assets under management were under $100 million. However, going back to his portfolio now, the reason it appears that he's making this 13F filing is that his assets have now gone over that $100 million threshold. At the end of 2018, he had $103.5 million under assets, which is why we now get to take a look into his portfolio. Now, to better understand his stock investments, we should take some time to try and figure out Michael Burry's investment perspective and how he manages his fund. Despite the incredible success of his fund from 2000 to 2008, Michael Burry doesn't spend a lot of time in the limelight, and there are very few recorded interviews with him. However, we can get a glimpse of his investment philosophy from this excerpt from his 2001 shareholder letter. In it, he says, "As much as the fund is a value fund, it is an opportunistic fund. And as much as I enthusiastically explore the values of each business behind every stock, I seek the pockets of the market that are the most inefficient, the most temporarily imbalanced in terms of price. Whatever extra return this fund will earn will be born of buying absurdly cheap rather than selling dearly smitten. I certainly have no proven ability to pick tops, and I do not anticipate attempting such a feat in the future. Rather, fully aware that wonderful businesses make wonderful investments only at wonderful prices, I will continue to seek out the bargains amid the refuse." So in his own words, Michael Burry is running Scion Asset Management as an opportunistic value fund. Based on this, I think it's fair to say and assume that he likely holds some contrarian opinions. Now, with that context in the back of our minds, let's take a look at the stocks in his portfolio. In his portfolio, Michael Burry owns concentrated positions in 16 stocks: CorePoint Lodging, Alexander & Baldwin, 5 Point Holdings, The Walt Disney Company, Tailored Brands, Facebook, Alphabet or Google, Cleveland Cliffs, GameStop, Sportsman Warehouse Holdings, McKesson Corporation, Western Digital, Altaba, Biogen, Celgene, and Mohawk Industries. These 16 stocks represent a concentrated portfolio, however, one that's still relatively well diversified. His largest position at the end of 2018 was CorePoint Lodging, and that represented 10.7% of his portfolio. The next 9 positions ranged from 9% all the way down to 5% of the portfolio, and his remaining 6 positions were around 2 to 4% each. Now, given that this is the first 13F filing in over 2 years, we don't know exactly at what point in time in the past that Michael Burry initiated positions in each of these 16 stocks, but we do know that at the end of the calendar year, he had these positions in them. So with that, I first want to discuss the top 3 holdings he had in his portfolio, which at the end of the year represented 28.5% of the portfolio. Those positions again were CorePoint Lodging, Alexander & Baldwin, and 5 Point Holdings. Now, what's interesting about these 3 top positions is that they're a stock of a very special type. And that is to say, these are Reit stocks, or real estate investment trusts. Now, typically, Reit Stocks will hold a diversified portfolio of real estate investments controlled by a single company and securitized to trade as a stock for retail investors like you and me. Now, actually, I haven't personally heard of any of these three REITs before, and that's probably for a good reason. If you look at the market capitalization for each of these three stocks, 5 Point Holdings has a market cap of about $500 million, Alexander & Baldwin a market cap of $1.7 billion, and CorePoint Lodging a market cap of roughly $180 million. These are all very small capitalization stocks that don't get a lot of coverage. While Alexander & Baldwin does have 3 bank analysts covering the stock, 5 Point Holdings and CorePoint Lodging only have 1 analyst that actually reviews and covers them. This brings us back again to the core philosophy with how Dr. Burry runs Scion Asset Management, specifically going back to where he seeks the pockets of the market that are the most inefficient. When we think about the market and the many of the large cap stocks, especially the S&P 500, there are many analysts and investors focused on these stocks, which may make it difficult for some value and opportunistic investors to find significant deviations between the price and what they believe is the company's true intrinsic value. On the other hand, when you're looking at much smaller companies that likely have significantly fewer investors interested or looking at them, there's a greater probability for significant price deviation from that true intrinsic value. Investors like Michael Burry might be taking a deep dive into these companies and believing that their assets or future value from cash flows is higher than the current price represents. Now, as these 3 stocks are new to me, I don't have any personal judgments on that intrinsic value at this time, but they may be worth looking into in the future. So we now know that about 30% of Burry's portfolio is in small cap real estate stocks. So what's in the remaining 70%? Now I'd like to highlight 3 additional stocks in his portfolio which make up a new investment theme. And this theme is cheap, beaten down retail stocks. In this case, those stocks are Tailored Brands, which makes up Men's Warehouse and Joseph A. Banks stores, GameStop, which some of you know I do own a position in, and Sportsman Warehouse Holdings. Combined, these stocks made up around 20% of the portfolio at the end of 2018. Now, if you look at the stocks of Tailored Brands, GameStop, and Sportsman Warehouse Holdings, one thing that sticks out regarding their fundamentals is that they're all trading at relatively low price to earnings ratios. These low price to earning ratios imply that the company is currently trading at a low multiple compared to the current earnings that the company is bringing in. Now, price to earnings multiple compression or lower PEs can occur for a variety of reasons. For instance, taking Tailored Brands as an example, when Joseph A. Banks and Men's Warehouse merged together to form one company, that combination significantly increased the total amount of debt for the new company, Tailored Brands. This high level of debt is obviously a significant concern for investors, and as such, most investors currently aren't willing to pay a premium in terms of that earnings multiple for shares of Tailored Brands stock. Now, should Tailored Brands manage to pay off their debt to more reasonable levels, one might reasonably expect that valuation multiple to increase in the future. That potentially might be one component of Burry's investment thesis with Tailored Brands. GameStop, on the other hand, is likely facing price to earnings multiple compression due to a different reason. In this case, investors likely aren't willing to pay a high price to earnings multiple for GameStop because they believe that future revenues and therefore future earnings for the company are likely to decrease in the future. Now, a decrease in future revenue or earnings for a company doesn't necessarily mean that the price to earnings ratio has to be rock bottom. But in the case of GameStop, where a large percentage of both their revenues and profit come from the sale of used games, a segment that's been seeing increasing declines in revenue with the onset and rise of digital gaming, many investors believe that there's a more significant risk of continued revenue declines. That's a very fair perspective and one that investors should definitely consider. However, I'll also give you my take. As full disclosure, I do own shares in GameStop, and so does Michael Burry, which my insights might be able to give some idea of potentially the thought process behind his investment in the stock. Throughout 2018, GameStop was in the midst of speculation of a private buyout. However, that wasn't the reason I bought the stock back in March of 2018. The primary reason why I bought the stock was because I believed the company was undervalued relative to their earnings, and that given how far the price had dropped, that an investor could still likely make a decent return even if pre-owned sales continued to drop. If it turned out that the decline in pre-owned sales eventually stabilized, potentially indicating that instead of being reduced to oblivion, the physical game market was simply resizing to a smaller base. If that were the case, investors in GameStop would stand to benefit from the likely increase in valuation levels, given that there's such pessimism in the stock. Now, I can't say for certain the exact reasons why Dr. Burry is invested in GameStop, but it's certainly a very deep value and contrarian investment bet which seems to fit and suit in line with his investment philosophy. Now, it's no surprise there's obviously still a lot of risk with retail these days. However, some investors may find opportunities in retail stocks that have been too heavily punished by the market. So together, beaten down retail stocks and real estate investment trusts make up 6 of the 16 stocks in the portfolio and around 50% of the portfolio's end-of-year value. Next, I want to cover what I see as the third investment theme with the portfolio, which is internet information providers and online advertising. This is represented by the two most dominant players in this market, which is Facebook and Alphabet, the parent company of Google. To a smaller extent within this group is Burry's investment in Alibaba, which is the remaining portion of Yahoo post the Verizon acquisition. Specifically on Google and Facebook, they are number 1 and 2 respectively when it comes to advertising dollars that are spent online. And in fact, as e-commerce continues to grow and more of ad spend moves to digital, Facebook and Google stand to benefit as some of the prime recipients of that new advertising money. Given the such strong growth prospects for each of these two companies in the future, and the significant industry tailwinds that both companies are positioned to benefit from, I can completely understand the value argument for each of these stocks, even maybe when compared to price to earnings, they are at or above market levels. This is one thing to keep in mind when value investing. Value investing isn't necessarily limited to stocks with low price to earning ratios or low price to book ratios. Growth or the future prospects of any company is certainly a component of the value when determining what a stock is worth. For this reason, under reasonable growth prospects for both Google and Facebook, I could certainly understand an investment thesis on each of these companies based on the belief that they were underpriced relative to future growth. Of course, growth estimates can be wildly volatile, which causes significant fluctuations in stocks where the majority of their value is based on expectations of future earnings. And as well, advertising dollars are likely to take a hit in the event that the economy runs into any type of recession or economic slowdown. However, over the long term, both Facebook and Google look well positioned to weather any short-term downturns in the ad market. Looking at the balance sheets of both companies, they have significant amounts of cash on hand and employ effectively zero debt. This gives both companies tremendous financial flexibility to operate however they best see fit, regardless of what the economic scenario is at the time. So while these may appear growth stocks on paper, the real value would occur if you believe that the growth rates currently being priced in by the market are below what your reasonable expectations are for growth of each of these companies in the future. I would have to assume that Burry believes that the growth prospects of each of these companies is currently being undervalued by the market. Both 5 and 10 years from now, I expect Facebook and Google to be bringing in much more revenue than they are today. So now real estate, distressed retail, and information technology make up 70% of the portfolio. Now we'll cover an additional 10%, specifically McKesson Corporation, Biogen, and Celgene. These three companies combined made up roughly 10% of the portfolio year-end value. Looking at a longer-term view of the stock price of each of these companies, McKesson and Biogen are trading well below their highs achieved in 2015, and before the news of the proposed Celgene buyout, Celgene was trading below 50% of its 2017 high. Both Celgene and Biogen are major drug manufacturers, and McKesson is the largest drug wholesale company in the United States. All three companies trading at relatively low forward price earnings ratios, implying market expectations for better earnings performance in the future. A value argument could certainly be made for each of these three companies. While they do have their own individual risks, long-term all three stand to benefit from an aging population in the US. That aging population, for better or worse, will need more medication that these companies can provide and distribute. Now that may or may not be part of Burry's investment thesis within these specific stocks. We don't know exactly how long of a time frame his investments are in these companies, but that is at least a positive demographic tailwind for these stocks. So with that, we've now covered 80% of Michael Burry's portfolio as of 2018, and now the last section I'll call other investments. Now these include the company's Walt Disney Company, which is actually his 4th largest stock position, Cleveland Cliffs, Western Digital Corporation, and Mohawk Industries. On the last two, Mohawk Industries and Western Digital, I think it's interesting to note that these two stocks in particular in 2018 were two of the worst performing stocks in the S&P 500 during that 2018 calendar year. Now, because Cyan Asset Management didn't have any 13F filings prior to 2016, we unfortunately don't know at exactly what point in time that Michael Burry made his investments in Western Digital and Mohawk Industries. If, let's say, he made his investments in these companies actually in the fourth quarter of 2018, it could have potentially been because of the belief that each of these two companies were too heavily oversold during the year compared to their actual business fundamentals. Now, in one of my earlier stock portfolios, I had actually purchased Western Digital at around $60 per share or so I would be currently down on that position. And if Burry purchased shares at or above that level, he would be as well. On the other hand, going back to his statement in that shareholder letter, where he says whatever extra return this fund will earn will be born of buying absurdly cheap rather than selling dearly smitten, it's very likely that Burry may have had the patience to wait until prices became absurdly cheap, reaching levels below $40 for Western Digital at the end of 2018. I just think it's interesting that while many investors may be staying away from last year's worst performers, Burry is looking for value wherever he can find it. The two other positions in this remaining section were the Walt Disney Company, or Disney, and Cleveland Cliffs. Cleveland Cliffs is an iron ore mining company that's trading very cheaply compared to earnings. However, the company is employing a relatively significant amount of debt. Disney, on the other hand, is trading at around a price to earnings ratio a bit under 16 and a forward price to earnings ratio at around 16 as well. This similarity between trailing price to earnings and forward price to earnings means that the market expects that earnings per share will be roughly the same next year as it will this year for Disney. Now, as you can see from the long-term stock price chart of Disney, they saw significant growth in their stock price from 2012 to 2015. However, from 2015 to today, Disney's stock price has been relatively flat. Of course, over that period of time, you would have been collecting the roughly 1.5% dividend, but that really isn't too much to show over the last 4 years in terms of total return. Disney's new upcoming streaming service might be a new opportunity to gain some traction in both revenue and earnings growth for the company. To what extent this is a component of Burry's investment thesis in Disney, I'm not 100% sure. However, he clearly had some conviction in his investment, as at the end of 2018, Disney was the fourth largest position in his portfolio and the largest position in his portfolio if you exclude the real estate investment trusts. So there you have it, Michael Burry of Scion Asset Management and his 2018 investment portfolio. Now, many people consider Michael Burry a genius for predicting the financial crisis, exactly why it was going to occur, and then making millions by profiting off of it. While this is no guarantee of his future clairvoyance or investment returns going forward, I still think it's worthwhile to sometimes take a look at what other smart people are doing and to see if we can learn a thing or two from them. With that being said, let me know in the comments below what you learned from this video and what you found most interesting about Michael Burry's portfolio. As always, thank you so much for watching. My name's Michael, and I will see you in the next video.